Do it. Okay, 5, 4, 3, 2, 1. Wait, what's this called? Big announcement?
3,
oh, yeah.
2,
5, 4, 3, 2, 1. Welcome to the Big Announcement Coming Soon podcast. I'm one of your hosts, Michael Bull, joined today by David Collette and Jeff Renson. Nick is away today with nanny problems, and if you don't live overseas, you probably don't get that, so we won't go too much into detail about all that, but suffice to say, it's nothing immoral.
There you go. This is PG. Nanny problems.
Yeah, he didn't run off with the nanny.
Nick is just having a busy week. Busy week. Good morning, gentlemen.
Right. You know, in crypto world, a bunch of crypto bros like, yeah, dude, nanny. Right. Yeah.
Yeah.
Nanny.
Not how it is. More like, I need to have someone look after my kid and I don't have one. More boring like that, but fair enough.
No, it's 2008 all over again. It's the end of the world. We thought everything actually was fine. It wasn't the end of the world until I woke up this morning. I see this thing called Credit Suisse, and that sounds kind of like a Swiss organization. So I think, David, you wanted to talk about that.
Well, back up. It was the end of the world on Thursday. We were fine by Sunday or Monday. We were back. So we've already been to Armageddon once, and this is
so it was Lehman Brothers 2 days ago, and now it's the whole financial system.
Almost, not quite. Bear Stearns, we would, but I'll get into that in a second. Yeah,
who went down? Lehman Brothers went down first, then it was Bear Stearns, right? If I remember.
No, Bear Stearns first got bought out,
and then it was Lehman second.
Sure. Oh. I just watched a whole bunch of podcasts on this last night, so yeah. I'm sure.
You watched Big Short again, that's why.
I should. I will tonight, actually.
I can't remember. I give one a friend of mine, just a quick little aside here. A friend of mine who we were sitting at recess one day watching the kids play, and we were talking about the financial collapse, and he's like, yeah, I talked to my broker today, my financial advisor, which first was a knock against him because I don't believe in those people, but anyways, he said what should I do, and the financial advisor said, spend it, just spend your money. I'm like, that was like the best advice you could get, because you don't want to invest it, just spend it. And I said that felt right at 3% a year.
Yeah. It's interesting. Yeah, it's interesting advice.
Spending,
I mean, we went through.
We'll talk about that later, but they were guaranteeing it was going to collapse. The money value was going to go down. Just get rid of it, get assets. David, you were talking about Indo, right?
Yeah, we went through the collapse of '98 in Indo, and then you were spending 2,500 rupiah to the dollar, and it went to 17,000, which is like a 5-8x.
Free TV sets for everybody. Yeah.
Well, that's it, right? It was essentially this weird race where everyone took their money that was in dollars, switched it into rupiah, and then said it got like 3x or 5x, whatever their money. And you went to the malls, and people were like closing shops because they were like needing to reprice things because everything was just now like a third the price. And it was like, so like it was this bizarre situation where it definitely ethical dilemmas, right? Because like you're sitting there as a foreigner, sitting safe in dollars while the world collapses around you. If you spend your dollars, you're helping the situation, but you're also getting this most ridiculous deal. So you're gouging the small business you're getting the deal from. So it's just, yeah.
Because I remember we bought like a base and amp and a bunch of stuff, and talking to the store owners, there were controls about pricing from import goods, so they couldn't raise their price on old import stuff. They needed to get rid of everything, then get the new stuff in, come in at the new price, and it would be priced fairly in dollars. So we felt bad, but then after talking to business owners, they're like, please empty the store, buy everything, and we can get new stuff in and figure this out.
Yeah, exactly. So it depends on what you're buying exactly. But most of the things that we were buying were these high-end goods that are usually an import. So computers, golf clubs, and stuff like that. So yeah, we
different story with food and things.
Yeah. All right, white people to the rescue. Now, who was the first one here to speak? Was it you?
Well, I'm kicking off, I guess.
That's right. We're talking about credit. Well, I said let's talk about Credit Suisse, and then Jeff's like, no.
Oh, yeah. Well, Credit Suisse is essentially probably the end of the story, if I tell us my part of the article or at least like topic today. So I suppose we'll get to Credit Suisse, but let's say Credit Suisse right now is I guess what you would be looking at as your Lehman situation, whereas Silvergate would have been your Bear Stearns situation. Okay. If we were just not really, because Lehman was like, I think 6 months later or whatever, but still nonetheless, this kind of analogy. So if you think of this, so firstly, I just want to plug like where I get my source. So Jeff Snyder from Eurodollar University is my new best friend. And well, he doesn't know I exist actually, but I like him a lot and I watch his podcast daily. He is massively doomer, but at the same time, he's like dedicated his entire life to studying the Fed and the SEC and has very interesting things to say. And the way what he says is, pretty compelling. So here's a situation essentially that what he would argue is that firstly, when we started jacking rates up in response to inflation being too high, he would argue that actually inflation was too high. Why? Because supply chains were shut down. So you restrict supply, you close down the economy, and you restrict demand. So people are not making as much stuff. And then suddenly open up the economy and you haven't unleashed supply enough yet. And also there's low inventories because people didn't expect it to open yet. And suddenly there's a huge amount of demand and not enough supply. So inflation would go up. So inflation was, in his words, actually transitory. It's more like transitory of 18 months rather than 6 months. And so that was a wasted word, if you will. But
redefining the word.
Yeah. And so like everyone's saying, oh, well, inflation is sticky, et cetera, and so forth. Well, his position would be that actually it's not. And the way you can tell it's not is that banks and, well, essentially the treasury inversion of the curve is like at ridiculous all-time highs. What that means is that
you're talking about the yield inversion, right?
Mm-hmm. Exactly. Yeah. And so what that means is that the market, big, large players in the market are positioned believing that the interest rates will be lower at this point by like 2 points. Like, so we're at like 4.75 now. The market believes we'll be at 2.75 in the end of this year. Which is pretty crazy because the Fed is saying we're going to actually keep going up.
Yeah,
right?
that's what
the market's saying this, and the Fed is saying this. And so we would say it's wishful thinking. But the interesting thing is that every time in history this has happened before, the market has never been wrong, and the Fed has always been wrong, or at least the Fed has had to do something to fix what broke. Essentially, the Fed is waiting for something to break, right? And so his argument now is that that's what's happening. Things are breaking, and so the reason is
all because of the failure of a couple banks.
Well, this is how it will break, and this is why it's like Bear Stearns. This is a really good example he used. When Bear Stearns was rescued and sold to J.P. Morgan, everybody celebrated. Main Street was like, "Yeah, we fixed the banking problem," and the government was like, "Yeah, we fixed the banking problem," and the people in Bear Stearns were like, yeah, okay, I had to, sell it like all my equity and didn't get much money, but I guess the banking problem is fixed. But every other bank manager out there looked at Bear Stearns and said, holy crap, man, we can actually fail. They'll let us fail and all of our equity will be worth nothing, whatever. So they all just tightened up and stopped lending to each other. They stopped pumping money into the economy, all the venture, all the innovation was just pulled it right back, right? Mm-hmm. And they just bought treasuries. And right now, we'll get to that in a second, long duration treasuries, to get interest from the market because they couldn't trust that these things would succeed. And so as a result, liquidity just sucked out of the system and bang, recession.
Well, the other thing with 2008, banks were risking money in the terrible MBSs, mortgage securities, other different things were going on. And I think this is important to make this point as we went to Silicon Valley is they went to safety with treasuries and the Feds. They were responsible and not taking risks. And I know with time duration, there is some issues, but the overall message is, and the issue that Silicon got into is they decided to be safer.
Yeah, well, it's interesting. There's two sides to it. So that they didn't manage their risk book very well because they weren't hedged. That was the one thing they did really wrong. But it's not like they weren't regulated.
When you say that, you're talking about SVB, right?
Yeah, exactly.
Yeah, they didn't keep enough money in deposits.
Yeah, well, what was happening is too, like, and this is what Jeff Schneider was saying as well, is that what people weren't understanding is that, yes, they didn't keep enough money in deposits in case a bunch of people were taking money out. But what was also happening is that a lot of people were just taking money out anyway, because startups right now in the world are like not doing well. They don't make money. So they're constantly taking money out and not putting money back in because it's bear market. So their cash reserves are actually depleting way quicker than they thought. And they're like, oh no. Mm-hmm. And so what should happen? And this is the really interesting point, right? So what should happen in a healthy banking economy is that Silvergate would just reach out to like JP Morgan or something like that, just like First Republic just did like 2 days ago. JP Morgan gave First Republic $70 billion. All Silvergate needed was $1.8 billion, and it couldn't find it. And it couldn't find it so much that it had to sell its treasuries at a loss of $1.8 billion, which triggered a bank run and put it out of business.
And when you say Silvergate, you mean Silicon Valley, right?
Yeah, Silicon Valley, yeah. And so for that to have occurred means there's a lot more fear in the system than you think. Like, surely they would have just been like, oh, this is going to cause a lot of fear. I'll actually grab it from somewhere else and back this up. But instead of that happening, it went down. So irrespective of whether they've backed it up now with all these Fed, this instrument, whether it's a bailout or not, the behavior of these banks is now going to fundamentally change because they're now in a danger zone. I mean, you just think of a consumer. You're like, oh, I'm going to bank in my local regulatory bank called, like, I don't know, whatever it is, Joe Schmo's bank. No, I'm going to go to JP Morgan, put my money there because I know that stuff is safe. I don't want to play around anymore. And that just money just sucks out of all these regional banks.
Well, and how many of those little ones failed? Because David, you've talked about how many of them died already.
Well, a lot in the past have died, but the other thing is that, like, here's the problem with this is that if you're almost balancing out and you've got your book in long-term treasuries, you just have to hold on to those and let them kind of wait till maturity to get your money back. What that causes in Japan anyway is zombie banks, right? That's kind of coming to America. So whereas the bank can't do anything, it can't lend any money because it doesn't have any, because it's just waiting for its deposits to mature so it can kind of get it back. So it just has to sit there doing nothing. So it's just like a dead bank, if you will, waiting to come back to life sometime in the future, hopefully. And so in that circumstance, the only way for that bank to get out is basically be acquired by a larger bank. Now, the problem in the world also is, you guys should just watch Jeff Schneider, but the problem in the world is, and Germany actually surprisingly does a pretty good job at this, is that banks are consolidating. In 1960s, there were 22,000 banks, right? Mm-hmm. Now in America, there are 6,000. Why? Because they just keep getting consolidated by the larger bank. What happens when you do that is large banks only care about large deals, right? They don't care about lending to like mom and pop stores and making like special.
That's not their customers.
Exactly right. So the more you consolidate, the more right. The more the middle class loses their opportunity to go and get like deals from like local banks. Germany actually does a very good job of this. They've maintained their banking sector, which is why there's so much middle class borrowing still available. But when you do that, then it creates a huge problem. So that's exactly what was happening. Like these banks had to go niche. They had to go to like startups because they couldn't afford to compete with these guys. And so they put themselves at risk, and they didn't even think they were at risk, right? They were in long duration securities, which is like probably like the fourth safest thing in the world. Like, and so that leads us to like Credit Suisse, right? So this whole situation happened. Fed is going to back up all banks that have problems like this. There's a huge dip because everyone kind of had the reaction you would have, like, okay, that's great, they're going to back it up. Still moving to JP Morgan because just safer, you know what? I'm just going to do that. So they did that, and then the banks came back after rebalanced. The problem is that, though, now you have kind of a zombie situation where the banks don't want to lend and liquidity sucks up, which is exactly what happened in 2008, right? That's why they've had these TARP programs to kind of get the banks to start lending again. They forced the money into the system, but they are in QT right now. They keep sucking money out of the system. So now they face a difficult choice. Now, did they fix the problem on Monday when they fixed Silvergate Bank? Is it all, Silicon Valley Bank?
Just SVB.
SVB, or is it over? Well, Jeff Schneider would say that if it is analogous to Bear Stearns, then that's when they sold it off to another bank. It was all fine and it looked okay. But the markets freaked out. And then what happened over time is that then manifested into actual risk for companies, and they started going under because of subprime. And that was Lehman Brothers and the people who insured Lehman Brothers, et cetera, and so forth. In the same way, Credit Suisse, you could argue, might be that example. Like, okay, the FDIC, and I'm just making this up, I could be totally wrong. The FDIC backed up all of the long duration bonds that are owned by American banks. So problem solved, right? Oh, what about Credit Suisse? Maybe they have a whole bunch of those as well. Does the FDIC back up Credit Suisse? I don't know. I don't know what happens, right? These are just the external effects that kind of happen, and you just
because SVB had a subsidiary in the UK, and a HSBC had to buy them up for $1 and got no support from FDIC. So the subsidiary of SVB got no help. I'm guessing, Credit Suisse is going to get nothing from FDIC.
Yeah. So how much money is being put into buying zombie banks to be zombies rather than productive banks? And that will be the drag on the economy that causes a recession, not are the banks safe or not? It's what happens. What do the banks start doing because they realize they're not safe?
I think you're way overplaying this. I don't see any parallels at all to 2008. Now, we'll talk in a week and see who's wrong here, but Silicon Valley Bank was unique in that it took all its money from startups and crypto bros, right? So the other banks aren't like that. It's not like it's mortgage-backed securities, which were all the way across the system.
That has nothing to do with why it failed.
Like
they wanted their money back. Why was the bank illiquid? The bank was illiquid because it had 10 years.
It was illiquid. They didn't have enough deposits, and they put the rest in long-term
had enough money
treasuries
or assets.
So
if it didn't have a run on there,
but
or
the reason
it
failed is because a certain culture, which is startup, panicked. But that culture doesn't exist in all the other banks.
But the bottom line is, if I want
not?
my money back from other banks, the other banks are at the same 10% line of they have that liquidity and they have long-term treasuries. It's just a matter of, do people want their money out at the same time?
Yeah, do people, but who are those people? So I'm saying those people were startup people, not you and me.
Here's the question. If the long-term duration securities or treasuries are worth less than $1, how many of them are out there and who are they owned by? If they're owned by international banks who are not backed by FDIC, they could take those banks out. Like Credit Suisse is going down right now.
If there was a run. I mean, if there was a run, but what makes you think there's going to be a run?
Well, look at Credit Suisse. Look at its chart. It used its price. Credit Suisse, right? One of the biggest banks, right? $140. Do you know what price it is now?
$8.20.
No, I don't.
$1. It's 20% down today, right? This is one of the biggest banks in the world, down 20% in a day.
Mm-hmm.
That doesn't feel like not a bank run to me, right? Like, and you got to ask why. What did Credit Suisse put his money in? Well, before it put his money in Tiger Global. Boom. Archegos. Boom. Several things have blown up. So it has massive debts on its sheet as already. And if it takes on another massive debt because of this problem, it's kind of like, which is the last straw that breaks the camel's back? It won't happen slowly. It'll happen bang. Like 2008 was like not slow, right? It was just like all of a sudden we were like coasting along, buying sweet houses and having like whatever. And then all of a sudden houses were worth nothing and everyone was poor. So I'm not saying that will happen right now or whatever. There'll be some fighting to do. But right now, I would argue that the economy, everyone is like, just remember, like last week, everyone was like, economy's super strong. Inflation is sticky. We can't get the inflation down. Too much people have too many money. We have to give them less jobs, get people fired and stuff. And now we're talking about, is there going to be bank runs? And why is Credit Suisse down 25% in a day? Like, that was pretty crazy, right? Like on Monday, when all those banks went down, they went down like 10%. JP Morgan went down like 8%.
Yeah,
like,
I know.
First Republic
I feel like
you're
I feel like this whole argument is speculative. It's just a good guess.
I feel like
I don't see the science behind it.
There's one way to play it out, and banks can either continually fractionally reserving and buying T-bills that are the safest thing. Let's say they all go to 3-month ones. But the system is designed that people cannot have their money back. Like, Mike, you're advocating not for a bank run. It's not a bank run. It's, can I have my money back, please? And they're like, no, we don't have it. But they didn't risk it. Like, I mean, Credit Suisse sound like they had some blowups, but for people buying T-bills, it's like the low risk option. So fundamentally, the system, unless we all participate and don't actually hold our own money, we're all bailing in the system continually. That's what the banking system is.
Here's an interesting point, actually.
So why would that change?
After so many years. Well, yeah. Well, no, it's not a scam, but I would argue it's no longer really that competitive. And here's why. Like, we used to live in a day where you're like, why did you put your money in the bank? To earn interest. You get like 5% interest. That was great. Now, why do you put your money in the bank? To know. You get 0% interest. Why don't I buy 4-year treasuries?
Interest rate
because you have
5%
to. So. Because the government won't let me keep that much cash in my house. They will take it from me if I have that much cash in my house.
Okay, yeah, but that's the prepper argument. But the real argument
the mattress
is
argument.
Here. I hold money at 0% in a bank, or I hold treasuries, 10-year treasuries at 4.7%. Why would I put my liquidity in the bank?
And if nobody's out of the treasuries,
you can sell treasuries. You can sell
convenient, and put it into the bank so that I can write a check.
Yeah, so your savings, you're telling me with your savings, you're going to keep them at like 0%? Or like,
no,
I invest it. Not 10-year. Let's do it at a 1 year. Let's do it at a 1 year at 1 year, or even a 3-month at like 2-3%. People who usually use banks should actually be now treasuries brokers, right? Because essentially this is now the bank. You buy treasuries, the government will give you 2 or 3%. You put it in the bank, they'll give you no percent. Why should I hold money in the bank? Unless it's
otherwise I can't spend it.
Cash.
It's kind of hard.
Okay, if you're living check to check, but if you're actually saving money, why would you keep your money in?
You wouldn't. Like, who saves money unless they're other than having cash as a backstop? Who saves money anyways in a bank? Nobody does. Do you? Like, I don't. I invest it.
VCs and also
they need the cash.
This is the argument,
payroll,
right?
For example.
So instead of investing in a startup with my money as a VC, I'm going to put it in treasury bills because it's delivering way more money than the startup might be because I'm actually scared. And so instead of investing in innovation,
no sense. That's not what a VC does at all. They're not looking to minimize their money. They're looking to maximize their money. So that's why they take high risk.
Lose it too.
That's why they're a VC.
No, this is how that works. A VC will put their name and credit down with a bank to take a loan out for their VC. They're not putting their own money down for that. The bank will no longer give them that because it doesn't make sense anymore in this environment. That's the problem. It's not that the VC doesn't want to keep lending. The VC do, of course they do. But because you just said the bank that all the VCs banked out just got shut the hell down, that's gutting of that, right? So what happens when you gut your innovation layer? I mean, it slows down.
Have you truly? It's one bank. It's not the entire system. It's one bank.
But the fear is everywhere. Again,
the fear is everywhere. Like, so if you're a First Republic bank, are you saying, oh, sweet, let's sign up all those VCs who just left like that other bank? No, you're like, no, let's actually start investing in like, homes and people's savings accounts, people who are safe, who don't like pull their money out like this after they get a message on Twitter.
I don't get it. And plus, don't forget SVB was bailed out. So everybody's made whole. So it's not like they lost the money. It's still there. You can still do everything you were just talking about.
And that's the moral hazard. If I'm a VC. There.
Well, speaking of moral hazard, Paul Krugman.
I do want to.
Let me just finish real quick. Is Paul Krugman? I just read an article from him this morning. He's worried about the possibility of moral hazard because they're doing more than the $250,000. And his response was, "Oh, I wouldn't worry about that. Those guys aren't that smart. They invest in crypto."
That's awesome. Well, Paul Krugman's awesome. He's a bottom signal and a top signal. Like, it's fantastic. Yeah. He always gets it wrong. I used to be a Krugman fan. Don't get me wrong, but
there was a time in the late '90s where he nailed it for like 2 years, and then he's been riding off that.
All right, Jeff, I interrupted you. What were we going to say?
SVB's bailed out. Yeah,
that's cute. Yeah, your boobs are incredible. Oh, I'm reading the shirt. Got it. Yeah,
you can see anything. Right?
Long Bitcoin, short the banks.
I just have my Bitcoin 2008.
This is an opportunity here. We've got Credit Suisse. I'm going to trade Credit Suisse right now.
This feels more like 2018 when I got in and how everyone was telling me I'm an idiot except for David, of everything being bad. And all the signs to me say like, well, what else am I going to do except for buy Bitcoin? The SVB thing I want to say is even that as a bailout is a politically charged term because we're not buying shit assets, or the FDIC is still acquiring treasuries from them, not MBSs that they have to write to zero. In 8 years, they can still, anyone who buys out the assets from SVB can cash them at 1-to-1 value. So it's a very, like, bailout is meant to make us mad at the bank. Calling it a crypto bank is meant to make us mad at the bank, right? Not addressing the fact that because people are like, oh, well, it's all this VC money that they pulled. Well, putting money in and out of bank is fine. Owning treasuries is fine. They're trying to paint a different story of who got hurt so that different people are mad about it too.
Yeah, that always happens. They try to like essentially read through the lines and just be like, okay, I erase this part, here's the facts. But what I think is interesting is that, let's talk about moral hazard for a second then. Like, so you're going to buy back everybody's at like send $90 at a dollar, right? You're going to give them the thing. And now that's a thing that happens. If you're in trouble, that's what's going to happen. So what are you going to do as like any other bank, one of these larger banks? I'm going to go about and buy long duration securities because they give me the best return on my investment. And I know the FDIC is backing me up now.
Well, right now with YCC, short terms are
more risk.
That's the moral hazard.
Isn't YCC with short-term bonds being worth more, forcing bankers to make the better choice of buying the 3-month bonds currently?
They're gonna go out in the risk spectrum, right? They're gonna buy longer duration bonds because they know they're backed by the government, and they're getting it.
No, I'm saying the YCC
cost the government a lot of money.
I can say you can secure the long term over that term. The short one is renewed and at a lower value.
Our two arguments here kind of show our biases. So we have you two as the crypto bros, like, are always waiting for the end of the world, kind of excited about it because then your Bitcoin is going to be legitimate. And you have the Gen X institutionalist, me, who's like, no, it's the institutions that we have to believe in, because if we don't believe in them, we're screwed.
I would argue I'm in the middle. I'm actually in the middle. I'm more perturbed that our institutions are so broken, and I hope for their best, but I'm just kind of calling it as I see it.
Yeah, I wanted to burn it all down before Bitcoin got invented. Bitcoin's just a side play for burning it all down.
That's true. I was in economics with Jeff. He was definitely always like this.
And Elizabeth Warren, then
in high school.
I assume you're going to support her.
Oh man, Elizabeth Warren, she has just gone off a cliff. Like,
she used to say things that were like pro people, and now she loves banks.
She's quite the regulator, and you were just talking about how great Germany is.
She's not though. That's the problem. Like, what she wanted to do, essentially put these banks out of business, right? And so, like, essentially, she's helped create the problem. And then each time that it's not even that's the problem. It's more that like she's just reactionary and she just plays it as she sees it. Like, oh, this bank went down. Who's investing? It's dirty startups.
Yeah,
and it's dirty crypto. And just like, I mean, like just said, it used to be about people, right? I'm liberal, right? But it's really hard to support Elizabeth Warren and what she says because it's just so dumb and uninformed. And so it's just, it's a sad thing.
It's the reactionary stuff. Fair enough. I was a bigger fan in the old days with her before she became a senator. She was just a professor.
Yeah. I mean, if you can focus on something, I think you get really good at it. If you start focusing on too much stuff, you just start talking crap.
Yeah. So Jeff, what are you focused on?
I'm focused on the good news. So we have all these games. We've talked about being in the Asian monetary crisis back in '98 and whatever's happening now with currencies and banks. But there's 21 million Bitcoin today, or there will be. There will be in the future, just 21 million. More so, Amazon's launching an NFT platform. Credit card you get an NFT. The system's not right. They're not getting rid of crypto. Amazon's not investing in something that's dying. And Amazon definitely is talking to more regulators than I am as far as should we go ahead with this. Kraken is finishing up I don't know what the paperwork, finishing up securing their bank in Wyoming. So it's going to be one of these special purpose deposit institutions, kind of like this mid-level credit union sized bank. They're not large, but it would facilitate Kraken having its own access to the banking system. Mm-hmm. And then along with that note is BlackRock's involvement in Circle. Circle's gotten all their money back from SVB, and now Coinbase and Circle will be banking with, I think, JP Morgan. So on one hand,
Bank of New York Mellon.
Oh, BNY. Okay. New York Mellon. Okay. So on one hand, we can't necessarily, I used to get money from Coinbase into my bank account on a Saturday or a Sunday. That'll be a Monday or a Tuesday. But did they kill crypto, or did they say there's a lot of money to be made? I want it, because they killed Signature Bank. You can see what Barney Frank said. And then they took the business. Did they just want the business? It's not about killing crypto. It's about giving crypto business to the right people.
I think that's, it's interesting. I think we live in a world where conspiracy theories have come right. So I think that's a little out there, but I also think that what's interesting is it is currently happening. The FDIC is running Signature Bank, which means they're running Signet, which means they're actually running crypto payments. Who would have thought that in this day and age, FDIC was backing crypto payments by de facto? I mean,
isn't that your dream?
A week. No, that's the enemy. Have you not seen Mr. Robot?
Yeah, anyway, the more regulation, the more Bitcoin goes up.
Yeah, I don't know. There is such thing as, too much, too far. But I think what's interesting, though, coming slightly back to all this good news, like let's think about it from a weird perspective. Let's say that it is like 2008. Unlike the COVID crash, which was like, oh my gosh, we're having like a totally weird, bizarre existential threat. This has nothing to do with banks. This is to do with a disease. Okay, weird. So let's be more analogous to a crash that's similar. There's a banking crisis, right? Bitcoin was created in a banking crisis, and over the course of the next 15 years, it was adopted and tried out.
It happened to be. That was more.
Well, yeah, no, I mean,
the theory behind the philosophy behind the need for it is we are going to hit this banking crisis, and we just did, and we're going to hit it again. We are now.
Okay, yeah. Conveniently.
Which is what in the Genesis block, there is the article from the second bailout of the banks from the Times listed in it. So it is Satoshi's mantra, essentially. So it is purpose, whether it's purpose built for this or not, it's just convenient either way. But it doesn't matter, because the thing is that under a banking circumstance, this is why Bitcoin was created or is perceived to be created. Over the course of time, it does all the things with all the money printing. Who cares? Now we enter another banking crisis. Everyone is already onboarded to Coinbase, knows all about Bitcoin, has lost money, has made money, who did whatever. But now we're actually reaching a point in time where there's actually a thing happening that Bitcoin was created to stop happening again for the first time. Not an economy is going down, but like banks are failing. And you have all these, if you think about it from a young person's perspective, right? Especially maybe not an American, maybe let's say a Turkish or Argentinian.
Or New Zealander or whatever, yeah.
New Zealander, right? Yeah, exactly. You're like, shit, man, I don't know, these banks are failing. And like, they keep, backing it up, and this same thing's going to happen again, this Bitcoin narrative is actually making a lot more sense. You don't have to win everyone. Even if you win just 2% of those people, that's enough to make Bitcoin go up. And then that wins another 2%. That's how it all happens, right? It's just like a self-fulfilling prophecy. So right now, when you look at it, there was a great chart the other day. I had like all the bank stocks dropping by like 15 to like 80% and Bitcoin up like 10%. It's fantastic.
I think that might be the only thing I heard today that you said that I agree with.
That it was fantastic?
No, that could happen. That 2% here, 2% there. That makes sense.
Totally.
And we've seen just how
happens.
rough it is to send money when we live in other countries. Getting dollars into Tunisian dinar was, well, impossible unless you carried it in. So Bitcoin was a better system than the banks. And now as the banks are collapsing, the money goes away. My Bitcoin's still on my ledger. I can still send it to somebody. Like, it really is a functioning system that's here and works also.
Right. Tied to the dollar.
And there's a bit of renegade revolution in the air, right? What CZ did was like, I'm going to swap for Bitcoin with my BUSD. The only reason that would be like socially acceptable right now is because the banks are failing. And so it's like, okay to like, change all your backing because that was the emergency rescue fund that he collected from all these people. We're not going to have that in dollars for rescuing. We're going to put it in Bitcoin. Sounds a lot like what Luna did, right? People would be blowing up like 6 months ago. Now, because banks are failing, this seems like a good idea. Like, so it's really interesting to see how like people's mentalities change over time based on what's happening in the world. And, things can carry away from themselves. Bitcoin's a small asset still. Like,
the power of faction. Okay, we only got a couple minutes left. So predictions for next week. David, you were hoping for 26 by today. As
we were 26.2 this morning, right?
Slack.
Yeah, it hit 26.
Yeah,
26
yesterday
down to
shot back up, right? We touched 19,
24,
back up to 26.
right now. Did it hit 26 before it? Oh, so you won that. Okay, next week then? Is your 2%? Are you going to pull us up to 50 next week or what?
Well, that's not 2%, Mike. I thought you taught math.
No. You're 2% more people are going to jump in the market. That's going to.
I see.
2% of all people will jump in, which would be twice the amount of people currently in the market.
Right. No. But that we also have to take account of paper hands, people who think that it's going to go down and it's all over because it's just a joke. So I mean, it is a scary time to hold Bitcoin, right? Also, banks are collapsing. Like, why would you hold a risk asset? But I'm going for 28, and then we'll go 32 next week. Okay. No, the week after, sorry.
Gotcha.
Woo.
I mean, 27 to 29. I'm same direction. I was calling lower the last couple of weeks, but same direction as David now, just not quite to 32.
You're taking the low risk. Yeah, just undercut David a little bit.
But we just need to leave everyone in this range behind so they feel bad about it and buying higher. That's the problem. Like, you can't hang out here too long and let people have good prices. It's not kosher.
They already missed 16.
All right. Well, it's been fun, gentlemen. We'll talk again next week, and maybe we'll be as excited as we were this week.
Well,
cheers, gentlemen.
Have a good one. 5, 4, 3.